Good morning, folks. I hope you've had a great week. It's been good weather here in Bangalore. Some of the sun has come back out and we're enjoying the sun. Rare for an Indian to be saying that, but yes, well, it's nice, pleasant weather here. And a lot of things happening all across the world. Sometimes it seems chaotic and sometimes it seems more chaotic. Can't decide which is the truth. And best is to sometimes I feel ignore all the noise. Because you see, not all the things that happen around the world impact the financial markets. It impacts our head, but doesn't mean it impacts stock prices. So we should try to learn and figure, discriminate between the two. What do you say?
Agreed, sir. It's very important to differentiate between signal and noise.
Yes, I know. And let's see, the hot topic continues to be gold and silver. Hot topics. Okay, and we can't just stop talking about these two in all our podcasts because every time we come here speaking to you, something has happened to the price. Not something small, something big. Okay, generally it has been shooting up higher and higher till yesterday.
So yesterday silver fell 9% in the US, and today in the morning in India as well, gold and silver both have fallen 6% respectively. And there are some things which have come out this week. So JP Morgan's former chief strategist Marco has come up with a statement which says that silver is almost guaranteed to drop 50% from these levels within a year or so. While it doesn't seem like a warning, it just seems like a for sure thing, right? So why is this? Is because he quotes that in 1970s, gold had surged from roughly $40 to $200, and it sucked in the euphoric buyers just like this time, and it crashed nearly to $100. So he says that this is not just this is just a normal thing at this point to be expected.
Dynamics around gold are so complicated. For example, what happened in the 70s when gold crashed? That was when President Nixon delinked the dollar from the gold. It was no longer the standard for the dollar. And naturally, it was in the interest of the US not to let gold appreciate. So it was like a careful, positive suppression of gold prices. The focus had to be on the dollar, not on gold, since they are dealing the two.
Okay.
They needed the dollar to be stronger, they needed more dollars to be traded. And hence that was positive action by the US government to keep the gold prices down. And even now, you may probably see, this is a tussle that I spoke of last week also. You may end up having a tussle between precious metals and crypto eventually. Let's see where it plays out. But the gold-silver ratio, which a lot of fund managers track, has compressed. Generally is around 80, that is the gold to silver is around 80 times, and now it is less than 50, it is somewhere around mid 40s or so. What does it mean when the ratio falls? It means that silver has become far more expensive than gold, than earlier, relatively speaking. So if it's a signal that you're following, it means that you should lighten up on silver, isn't it?
Yes.
And it so happened that yesterday we saw a crash in silver to the extent of 10% or so. But see, whenever prices shoot up rapidly, corrections can also be as deep. So if prices are going up 0.5%, 1% once in a while, you will not see corrections as deep. But when every day they are going up 5%, expecting a 10% correction suddenly is quite possible. And hence, people coming in at these levels have to be extra cautious because the day after you buy, you may have a 10% correction. And then no saying how you'll react to such a change in your portfolio value. So that is something. And precious metals are the ones that have been driving the returns of multi-asset funds. So multi-asset funds have again been the hot category. They've been driving the maximum investments in Indian mutual funds because multi-asset funds, as the name suggests, has bonds, has equities, has precious metals also. Okay. While equities have not done anything, bonds have not done anything for the past year, even then these are at the top of the returns category. If you're looking at the multi-asset fund returns chart on a 1 year, anywhere between 19 to 34% gains. Where did you get these gains? Not bonds, not equities,
Precious metals.
It is gold and silver. So if you're looking at those returns and investing in multi-asset funds, please be aware it may not be a repeat performance. Okay. If these metals cool down as they are bound to, okay, then you're basically depending on the returns of gold, of bonds and equities to drive the performance. The benefit is that the three categories supposedly, historically, have behaved different from each other. So you're getting a stable performance, different from your bond fund, different from your equity funds. That is the advantage.
So, I think even one of the things that has driven the silver rally is the liquidity in the market. So when there's an excess liquidity in the market, there is speculative trading also increases, and because it also increases your risk taking ability. So if you just see the data, the US money M2 supply and the China supply has also gone up. So it has gone up 8% year on year.
Significantly.
Yeah.
Both being the largest and the second largest economies.
Correct.
And their money supply has gone up by 8%. It obviously allows so much investment just to happen and speculative trading to happen. We're seeing that. So anything can upset the apple cart. If central banks decide to tighten, it can upset the apple cart.
Yeah.
Okay. If interest rates in the USD go up, it can upset the apple cart. If interest rates in Japan go up, it can upset a very large apple cart. And which is what is a worry. So what's happening in Japan? The Japanese yen started depreciating all of a sudden. Not all of a sudden, actually in the last 2 to 3 years it's been on a depreciating side, after depreciating for many years till 140 yen to a dollar, and now suddenly it went up to almost 160 yen to a dollar. So why did the yen weaken? The yen weakened because they had negative real interest rates. Inflation in Japan has been creeping up, okay, but interest rates have not been going up, because of which you have a negative interest rate, real interest rate, that results in a falling, depreciating currency. How do you set it right? When you have a weakening yen and you are in a country like Japan that imports a lot, you are going to be paying far more for your imports than earlier, which means inflation goes up in Japan. So Japan has been seeing increasing inflation, and then because of a depreciating currency, even higher inflation. But when you have a weak currency, your exports are better, right? Now Japan is a large exporting nation. So you have what you have when you have a weakening yen, you have exporters doing well and households suffering because of high inflation. And wages have not been increasing to the extent. So it's a very sensitive issue. It could happen to any country. But why is it so important that we are observing what's happening in Japan? Japan is one of the largest investors in US treasuries. Because they had a 0% interest rate for so many years, Japanese savings were being directed into the US. And if to control the currency, the Japanese central bank raises interest rate, it has been rising. But if it continues on this path and investors get a better rate of return in Japan, they will start withdrawing from the US.
Good.
One, incremental flows don't go there, and second, they will start withdrawing. And this is what happened to some extent last year, and then corrected itself. And if it happens again, it could upset the American markets. When did we see a point of fear coming in? For the first time, US said we should be buying yen to support the yen. Because a falling yen is not in their interest, because they know Japanese rates will go up, and then you will have the US falling in trouble. So the US said, let's buy the yen. And they're trying to support it and prop it up. So 160 yen go back to 155. But it's not a sustainable thing. If eventually Japan has to increase interest rates, you are going to see global markets going into some kind of a panic mode. Because of money coming back, and also if interest rates go up, then price earning multiples have to fall in Japan. What does it mean? It's bad for the Japanese equity market also, which has been attractive. So yes, different nations face different pivots, but Japan, given the status it has, the whole world is looking at that. and we should also be looking at them to see what happens.
Yes.
Yeah. We promised our viewers that we'll talk about which are the mid-cap funds
Yes.
that have outperformed. Did anybody actually deliver alpha? Were there actually skillful fund managers? Hiloni, what does your data say?
Yes, so we ran a data point for the last 5 years. So remember that we excluded any schemes that didn't have a 5-year history. So 8 schemes have driven alpha out of 24, which is roughly around 33% in the last 3 years. This is annualized data pointer. But if you look at in AUM terms, 50% of the AUM has outperformed.
Okay. So what you're saying is 1/3 of the fund managers
Correct.
managed to outperform their index.
Yes.
Okay, on price term.
Price returns, yeah.
But while we can say 70% of the schemes underperform, in terms of AUM, the picture is different because some of the schemes, outperforming schemes, are so large, it contributes to almost half the AUM.
Yes.
So half the AUM, investors in at least 50% of the investors, we can say roughly, benefited from outperformance, while 50% did not.
Yes.
Okay. But you have to be so choosy about the scheme then, because you should be in that 1/3 bucket. Outperformed.
Yeah.
Not easy.
And of course, it changes from year to year. So it's not fixated that you will always be with the winner, since this is an active fund strategy that we are looking at. So the consistency of performance becomes really important when you are evaluating. And since it's a mid-cap fund, downside protection is also something that we need to focus on in this case.
So every so often we would see, if you would create a calendar year table of the last decade or so, the ones at the top of the table are rarely at the top the next year.
Yeah.
They come down to somewhere in the bottom quartile.
Yes.
So it's important to see who's consistent so that your returns are also consistent and your expectations are met.
Yes.
So only 8 schemes out of 24 outperformed.
Yes.
That's tough. You better be picking the right 8 schemes. Okay, and not all the performance has been hugely outperformance. Many of them have been just on the border passing the index. And I think only...
Since this is regular, this would also have the expense ratios in.
Correct. So direct schemes, you will find more of the direct schemes outperforming than the regular plans.
Correct.
And that's the benefit of being in a direct. Yeah, and coming back to the economic survey that was tabled, of course it's a massive document, but a couple of points that I'd like to mention. There's a lot of optimism in the growth rate of India. So that has come out very strongly. While the risks are there, there's optimism, and I think we should go with it. And this time around, we are looking at a much higher nominal GDP growth rate than last year, which means that businesses should do better.
Yes, and that is visible in our Q3 earnings as well. So, which was not expected. We were expecting a very muted quarter. But if you just see the sales number of around 400 companies that have come out right now, the sales growth has been 11% year on year this quarter. Compared to last year, it was 6.8% year on year growth.
Yeah, I think we were all cribbing last year that revenue top line growth was very, very low, and that looks far better. And I guess part of it, this is Q3, so that is the October, November, December.
Yes.
And the benefits of the GST reduction would be
come in. Yeah.
We saw more consumer demand.
Yes.
And the income tax rate cuts, the GST cuts, all this would have helped drive consumption, and we saw better top line growth.
Yes.
I hope this continues. I really, really hope it continues. The other part of the economic survey, which I wanted to bring attention to, is the finance minister says it's okay to have a depreciating currency. We've of course mentioned many times that a depreciating currency is not bad because it improves our export competitiveness. And India, being a net importer, we desperately need to improve our exports in the face of US tariffs. So a depreciating currency will only help offset some of the ills of the tariffs and make us competitive. The worry in my mind was always, we are an importing nation. And if we have a depreciating currency, it's quite likely we are importing inflation. So a depreciating currency, while everybody may say is good for exporters, what about inflation, which we have to bear? But the finance minister has clarified in the economic survey that the benefits out of the exports will be far more than the inflation that we may import. And she says it is not going to have a significant impact on domestic inflation and the depreciating currency at these levels. So I think it's good to take away this. I mean, currencies are having a tough time across the world. Indian currency has had a very, very tough time. While the rest of the world has been appreciating against the US dollar, the Indian rupee has depreciated. Which is not good, and if it continues to depreciate, I am worried. It's a weakness to be taken note of.
Sure.
And I'm sure somewhere else in the survey, the finance minister has said yes, we should not have been depreciating as much, and we should look at it largely because net FDI has been marginal or nil. FII flows we know are hot, but FDI flows are supposed to come in and stay. And we hardly had any net FDI flows. So somehow these things should change. We are hoping that reforms will slowly bring back FII flows. But the good part is domestic flows are strong. They're keeping the markets up, and we can see that over time the domestic ownership of equities has surpassed FII ownership. All these years, the FIIs own more, and now Indians are owning more of our market than the foreign investors, which is good. We should earn the benefit.
Yes.
Okay. The flip side is, of course, when valuations are high, the foreigners are selling and we are buying at high valuations.
Yeah.
Right? We are giving an easy exit.
Yeah.
So that isn't a good thing. Also, nothing is clear and straight. Everything has a plus and a minus.
Yes.
The FII outflows, which have resulted in a weaker rupee. Okay. So what happens then? The central bank has to intervene. So the Reserve Bank did intervene and try to prop up the currency. They do it in bouts, not consistently. So the Reserve Bank did spend a lot of money in supporting the currency. That has resulted in liquidity tightening in the Indian banking system. So what have we been seeing? While the Reserve Bank has been cutting interest rates, bond yields have been going up. It should have been coming down.
Yeah.
So long-term bond yields have only been going up, and that is what you can see in the chart, which is very strange. Why is this happening? Because of liquidity tightness and the fact that state governments are going to be borrowing more. So state governments pay more to borrow than the central government, and you're going to have a much larger supply of state government bonds. Okay. So various factors. One of the most important factor here is the MNREGA scheme, which the central government is funding. Much of it is now devolved to states. So the states have to be funding the rural employment guarantee schemes, and so for which they have to borrow more. So the gross level, about 30 trillion rupees are going to be borrowed. And knowing this flood of bonds that is going to come, the market has been cautious and they are demanding a higher rate of return. So in spite of the Reserve Bank reducing rates, bond yields are not falling, they've gone up. And because of the liquidity tightness, even corporate bonds are gone up. Credit is going up. Finally, okay, deposit growth is not good, credit growth is good, governments are borrowing more. It's not the best of time for the fixed income market. And the short, while the government bond yields at the lower end, at the shorter end are low, corporate bond yields are high. Banks are paying more for 1 year certificates of deposit. So you see that the yields at the shorter end are good. So actually investors in short-term funds now are likely to earn a higher yield, at least for the next few months, than was expected. So this is the strange thing that has been happening in fixed income. What's happening in the US tech world?
That's also strange. So yesterday there was a mixed bag of US tech stocks performance. So Nasdaq, which is a tech heavy index, was down 0.7, but iShares tech software sector ETF fell 5%. What caused this? So Amazon had announced a layoff of 30,000 employees by May this year, last October. they have just announced that they will lay off 16,000 people.
Oh, right.
Yeah.
Okay.
There was a big announcement. Microsoft came up with their results, which didn't meet the street expectations. So Microsoft fell 10% yesterday. On the contrary, Meta had good results. It beat the street estimates and it was up 10%. So it's all haywired. And so Meta has also announced a capex of around $115 billion to $135 billion for 2026 for AI.
The same time last year when these tech companies announced huge capex budgets, markets fell.
Correct.
And this time it's the opposite.
Yes.
We never know which side of the bed the markets are going to wake up on.
Yes.
Yeah. And if the strange thing is Amazon decided to lay off 16,000 people, and a couple of days later FedEx also announces a similar layoff. This is if Amazon is not going to be shipping so many parcels, I don't need so many people either.
Correct. It's a ripple effect of a sense.
Yes. Anyway, so let's think. And for the next week, we thought that we will ask viewers to ask questions.
Yes.
What was the term you used?
Ask me anything.
Okay. Ask me anything. You can send in your queries on WhatsApp or on the comments box in the YouTube. And we're going to have an offsite next week. We'll sit there and answer your questions. Try to answer your questions. Don't ask too tough ones, please. Okay. Good day, folks.